We often approach financial decisions with an air of rationality, believing our choices are driven by logic and careful analysis. However, beneath the surface of spreadsheets and financial models lies a complex web of psychological factors that subtly but profoundly influence our financial behavior. Behavioral finance challenges the assumption that we are always driven by pure logic, revealing that our decisions are often swayed by emotions, biases, and cognitive shortcuts. By recognizing the biases that cloud our judgment, we can begin to deconstruct their hold on our behavior. This journey into behavioral finance will illuminate common psychological pitfalls and equip you with practical strategies to navigate the financial landscape with greater clarity and control. Prepare to challenge conventional financial wisdom as we delve into the fascinating world of behavioral finance, uncovering the hidden forces that shape our financial destinies. At the heart of behavioral finance lies the constant tug-of-war between our emotional and logical minds. Emotions, powerful and often instinctive, can easily hijack our best intentions, leading us down paths paved with impulsive decisions. Logic, on the other hand, strives for rationality, urging us to consider long-term consequences and make choices aligned with our financial goals. Imagine this: you've diligently saved for a down payment on your dream home, then you stumble upon a luxury car, sleek and tempting. Suddenly, the emotional pull of instant gratification clashes with the logical voice urging financial prudence. The key takeaway is that acknowledging this inherent conflict is the first step to making sound financial choices. We need to harness the power of logic and thoughtful analysis to temper impulsive urges and steer our financial ship towards a secure and prosperous future. Recognizing this interplay is crucial for anyone seeking to master their financial destiny. One of the most pervasive psychological biases impacting our financial choices is loss aversion. This phenomenon describes our tendency to feel the pain of a loss more intensely than the pleasure of an equivalent gain. This inherent aversion to loss can lead to irrational behavior, particularly in investments. For example, investors often hold on to losing stocks for too long, hoping to avoid realizing the loss, even when selling and reinvesting makes more financial sense. Loss aversion can also manifest as risk aversion, where individuals shy away from potentially profitable investments simply because they fear the possibility of losing money. Recognizing loss aversion in our decision-making is crucial. By acknowledging this bias, we can start making more objective investment decisions and potentially enhance our long-term financial well-being. Another powerful psychological bias that can lead us astray financially is confirmation bias. This refers to our natural tendency to seek out information that confirms our existing beliefs while ignoring or downplaying evidence that contradicts them. Imagine researching a potential investment opportunity. You stumble upon an article highlighting the company's positive attributes and impressive growth potential. However, confirmation bias might lead you to overlook or downplay any negative news or critical analyses of the same company. This selective intake of information can lead to a distorted perception of reality, potentially resulting in poor investment decisions. Combating confirmation bias requires a conscious effort to seek out diverse perspectives and actively challenge our own beliefs. Embracing this open-minded approach can help us make more informed and balanced financial choices. Anchoring, another cognitive bias that significantly influences our financial decisions, highlights the powerful influence of first impressions. This bias refers to our tendency to rely too heavily on the first piece of information we receive, the anchor, when making decisions, even if that information is irrelevant or arbitrary. Imagine you're negotiating the price of a used car. The seller throws out an initial price which, unbeknownst to you, is significantly inflated. This initial price, despite its arbitrariness, acts as an anchor, influencing your perception of a fair price throughout the negotiation. Anchoring can also influence our investment decisions. To mitigate the anchoring effect, it's crucial to be aware of its influence and to question the relevance of initial information. Remember, objective analysis trumps arbitrary first impressions. The adage safety in numbers might hold true in some situations, but when it comes to financial decisions, following the crowd can lead to disastrous outcomes. This behavior, known as herding, describes our tendency to mimic the actions of a larger group, especially during times of uncertainty or perceived crisis. The dot-com bubble of the late 1990s provides a stark example of herding behavior in action. Herding often stems from a desire to conform or a fear of missing out. We see others making money and assume they must know something we don't. However, blindly following the crowd can lead us to make emotional decisions, ignoring our own risk tolerance and financial goals. To avoid falling prey to herding, it's critical to cultivate independent thinking and base your financial decisions on sound research and your own personal circumstances. Developing a robust investment strategy based on your financial goals and risk tolerance is crucial for navigating market fluctuations and avoiding the pitfalls of herd mentality. We often treat money as interchangeable units, assuming that a dollar is a dollar regardless of its source or intended use. However, our minds don't always operate with such financial rationality. Enter mental accounting, a cognitive bias where we categorize money into different mental accounts based on subjective criteria, impacting our spending and saving habits. Imagine receiving a $500 bonus. You might be more inclined to splurge on a luxurious dinner or a weekend getaway, categorizing this money as fun money. This mental compartmentalization, while seemingly harmless, can lead to irrational financial behavior. Overcoming mental accounting requires recognizing that all money holds the same value, regardless of its source or intended purpose. By adopting a holistic view of our finances and aligning spending with our overall financial goals, we can avoid the pitfalls of mental accounting and make more rational financial choices. Navigating the complex world of finance requires more than just understanding financial concepts. It demands an awareness of the psychological biases that can cloud our judgment. Now that we've unveiled some of these biases, how can we overcome them to make sounder financial decisions? Firstly, acknowledging that these biases exist is paramount. We must accept that we are not always perfectly rational actors and that our decisions can be swayed by emotions and cognitive shortcuts. Secondly, seeking out objective financial advice is crucial. A financial advisor, detached from our emotional attachments and biases, can provide an unbiased perspective, helping us make rational decisions aligned with our long-term goals. Finally, cultivating patience and discipline in financial decision-making is key. Avoid making impulsive choices driven by emotions like fear or greed. Take your time, conduct thorough research, and don't be afraid to seek a second opinion before making significant financial commitments. Understanding the interplay between psychology and finance is not just an academic exercise. It's a powerful tool for achieving financial well-being. By acknowledging the biases that can lead us astray, we empower ourselves to make more informed and ultimately more profitable choices. Remember, financial literacy is not solely about understanding numbers and markets. It's about understanding ourselves. By recognizing our own psychological tendencies, we can anticipate potential pitfalls and navigate the financial landscape with greater clarity and control. The world of behavioral finance provides a roadmap for navigating the often turbulent waters of personal finance. By embracing self-awareness, seeking expert advice, and cultivating patience, you can chart a course towards financial security and achieve your financial dreams. The power to master your financial destiny lies within your grasp. All it takes is understanding the mind behind the money.